The market just made a move that 90% of retail investors completely missed. And if you don't understand what happened in the last 48 hours, you're about to make a very expensive mistake. 3 stocks are setting up for massive moves this week, but here's the thing nobody's telling you. 2 of them could easily drop 20% before they go up 50%. So which ones do you buy? When do you buy them? And more importantly, how do you avoid becoming exit liquidity for the smart money? That's exactly what we're breaking down right now. Let me start with something that's going to sound crazy. The best buying opportunity this week isn't in technology. It's not in artificial intelligence. It's in a sector that your portfolio manager probably told you was dead 2 years ago.
Energy.
But before you roll your eyes and click away, understand this. What's happening in energy right now is not a comeback story. It's a complete structural shift that most analysts are still too blind to see. Crude oil inventories just hit a 5-year seasonal low. OPEC production discipline is holding better than any point since 2016. And here's the kicker. Global demand from India and Southeast Asia is growing at 4% annually, while everyone's obsessed with slowing demand in Europe. This isn't a trade. This is a multi-year thesis disguised as a weekly opportunity. Now here's the bull case for energy stocks this week. You've got companies in the Permian Basin producing oil at $35 a barrel, while crude is trading at $78. That S, a 55% gross margin business, that S returning 60% of free cash flow to shareholders through dividends and buybacks. We read talking about companies trading at 6 times earnings with 5% dividend yields and declining share counts. The market is pricing these stocks like oil is going to $40. It's not. The rebalancing in global supply and demand fundamentals doesn't support that scenario unless we have a global recession. Oh. And if we have a global recession, everything in your portfolio is going down anyway. So you might as well own the cash flowing assets. But here's the bear case. And you need to hear this, because I'm not here to sell you hopium. Energy stocks are value traps until they're not. We've seen this movie before. Commodity prices are cyclical, and when the cycle turns, it turns fast. If demand from China continues disappointing, and if U.S. shale producers break discipline and start ramping production to chase higher prices, you could see crude back at $60 in 6 months. At that price, these stocks give back 30% of their gains before you can blink. It's the other risk. Renewable energy adoption is accelerating faster than anyone expected. And long-term structural decline in oil demand is a real thesis that could cap the upside on any rally. So you're not buying energy stocks for a 10-year hold. You're buying them for a 12 to 18-month cycle play, and you need to know when to take profits. Here's my actionable strategy for energy this week. Don't go all in on Monday morning. Wait for crude to hold above $76 for 3 consecutive sessions. That's your confirmation level. If it does, you dollar cost average into positions over 2 weeks, and you size this at no more than 8% of your portfolio because the volatility is real. You set a stop loss at 15% below your entry, and you take 50% off the table if you're up 35%. This is not a set it and forget it play. It says active money management. And if you're not willing to watch these positions, don't take the trade. Now let's talk about the second opportunity. And this one's going to surprise you because it's in healthcare, but not where you think. Forget the pharmaceutical companies with their binary drug approval catalysts. I'm talking about healthcare services companies and medical device. Manufacturers that are benefiting from demographic trends that are completely unstoppable. The U.S. population over 65 is growing by 10,000 people every single day. These people need hip replacements, cardiac procedures, diabetes management, cancer screenings. This isn't discretionary spending. This is essential healthcare demand that exists regardless of economic cycles. The bull case here is absurdly simple. You've got companies growing revenue at 12% annually, with 40% gross margins and 20% returns on invested capital. And the market is valuing them at 18 times earnings. Why? Because healthcare is boring. Because it doesn't have the sex appeal of AI and semiconductors. Because fund managers would rather own the 7th best software company than the best medical device company because it makes for better cocktail party conversation. That mispricing is your opportunity. These businesses have pricing power. They have recurring revenue through consumables and service contracts. And they have international expansion runways that could double their addressable markets over the next decade. But here's the bear case, and it's a serious one. Regulatory risk in healthcare is massive and unpredictable. You could wake up tomorrow to a headline that Medicare is cutting reimbursement rates by 15%, and these stocks drop 25% in a single session. It's happened before, it'll happen again. The other risk is technological disruption. What happens when AI-driven diagnostics reduce the need for certain procedures? What happens when gene therapies cure diseases that currently require lifetime management? These are low-probability, high-impact risks that you can't model in a spreadsheet. But they're real, and they could wipe out years of steady gains in a matter of months. Here's how I'd play healthcare this week. You're looking for companies reporting earnings in the next 2 weeks with consensus estimates that look too conservative. You want to see procedure volumes growing faster than population demographics would suggest, because that tells you they're retaking market share. You buy the day before earnings if the options market is pricing in less than 5% move, because that means expectations are low and you've got asymmetric risk-reward. You size this at 10% of your portfolio, and you hold through the earnings report. If they disappoint, you cut immediately. No hoping, no praying, just execution. Now here's the third play. And this is the one that's going to make half of you think I've lost my mind. Regional banks? Yes, I said regional banks. After Silicon Valley Bank, after Signature, after First Republic, I'm telling you, there's opportunity in regional banks. But let me be crystal clear about something. I'm not talking about buying the sector blindly. I'm talking about being surgical. They're well capitalized. Conservatively managed regional banks trading at 0.6 times book value right now because the market has decided every regional bank is a ticking time bomb. That's insane. That's emotion, not analysis. The bull case is pure math. You've got banks with Tier 1 capital ratios above 12%, loan-to-deposit ratios under 80%, commercial real estate exposure under 20% of total loans, and they're trading like they're going bankrupt. These banks are earning 15% returns on equity. They're buying back stock at these depressed prices. And as interest rates stabilize, their net interest margins are going to expand over the next 2 quarters. If you buy quality regional banks at 0.6 times book value, and they just normalize to 1.0 times book value, you're making 65% on your money. If they get back to their historical average of 1.3 times book value, you're looking at a double. The setup is there. But oh man, the bear case is terrifying. Commercial real estate is a slow-motion train wreck. Office occupancy rates are still below 60% in major cities. Refinancing walls are hitting in 2025 and 2026. If you pick the wrong regional bank with heavy exposure to office buildings and secondary markets, you could see them take massive loan loss provisions that wipe out 2 years of earnings. The other risk is deposit flight. We learned in 2023 that bank runs happen at digital speed now. If there's any whiff of trouble, deposits leave in hours, not days. And once that starts, it's impossible to stop. So you are not buying the cheapest regional bank. You're buying the strongest regional bank that happens to be cheap because of sector-wide fear. Here's the action plan for regional banks. You do the work. You read the 10Q filings. You look at the loan composition. You check uninsured deposit percentages. You want to see less than 40% uninsured deposits, less than 150% loan-to-deposit ratio, and less than 20% CRE exposure. If a bank checks all 3 boxes and it's trading under 0.7 times book value, you buy a small position, maybe 3% of your portfolio, and you watch it like a hawk. This is not passive investing. This is value investing with risk management, and the difference between the two is everything. Here's the line I want you to remember from this entire video. The market pays you for seeing what's obvious before it becomes obvious to everyone else. That's it. That's the entire game. Energy stocks are obvious to me right now because I'm looking at supply and demand fundamentals, not sentiment. Healthcare services are obvious to me because I'm looking at demographics, not momentum. Regional banks are obvious to me because I'm looking at balance sheets, not headlines. The question is whether you're willing to do the work to see it too. Or whether you'd rather wait until CNBC is talking about it and the easy money has already been made. Let me tell you what I'm avoiding this week, because avoiding losers is more important than finding winners. I'm staying away from anything trading at 50 times sales with no path to profitability. I don't care how revolutionary the technology is. I don't care how big the addressable market is. If you're not making money and you're burning cash, you're one market rotation away from being down 70%. And I've seen that movie too many times. I'm also avoiding consumer discretionary stocks right now. Credit card delinquencies are rising. Savings rates are at historic lows. The consumer is tapped out, and companies that rely on discretionary purchases are going to disappoint over the next 2 quarters. Don't be the person catching that falling knife. Now let's talk about valuation for a second, because this matters more than most people realize. When you're buying energy stocks at 6 times earnings, you're buying them at half the market multiple. That gives you downside protection, even if earnings decline 20%. You're still buying earnings at 7.5 times, which is reasonable. But when you're buying software stocks at 60 times earnings, you have zero margin of safety. If growth slows from 30% to 20%, it's multiple contracts from 60 to 40, and you're down 50% even though the business is still growing. Valuation is your margin of safety, and in this market, you need margin of safety because volatility is coming. Here's what I need you to understand about this week specifically. We've got economic data coming out. We've got earnings reports from major companies. We've got geopolitical risks that could blow up at any moment. Any one of these could move markets 2% in a single day. So you don't buy everything on Monday morning and hope for the best. You have a plan. You have entry points. You have position sizes. You have stop losses. You trade like a professional, not like you're gambling on sports. The opportunities I've laid out today in energy, healthcare, and regional banks are not get-and-trick schemes. They're asymmetric risk-reward setups based on fundamental analysis and contrarian thinking. They require patience, discipline, and the willingness to be uncomfortable while the market figures out what you already know. If you can do that, if you can hold positions while they're down 5% because you believe in the thesis, then you have a chance at making real money. If you can't, if you need instant gratification and daily validation, then stick to index funds and stop trying to pick individual stocks. I'm not your financial advisor. I'm not telling you what to do with your money. What I am doing is showing you how I think about opportunities, how I assess risk, how I build positions, and how I manage them. You take that framework, you apply it to your own situation, you do your own research, and you make your own decisions. That's how adults invest. It's not following someone blindly, but learning how to think for yourself. If this breakdown helped you see the market differently, if it gave you a framework you can actually use, then let me know. Drop a comment with which sector you think has the best risk-reward this week. And if you want me to go deeper on specific companies within these sectors, tell me, because I can do a deep dive on valuations, technical setups, and earnings analysis. The game is still being played. The question is whether you're playing it smart or just playing it loud. I'll see you in the next one.